Will Budget 2026 bring cheer to the Indian stock markets? Well, Indian markets have had a very volatile year in the run-up to the budget. Even though the domestic fundamentals are improving, we do see that global risks have remained elevated all through. As Budget 2026 is approaching, the big question is, can it truly lift the stock market sentiment? Well, let's break it down for you. Indian equities underperformed most global peers the entire last year of 2025. Broader markets disappointed, even though the Nifty managed to post just about respectable gains. Now, global headwinds were strong, from US tariffs to geopolitical tensions and a slowdown in domestic consumption that weighed on the investor sentiment back home. In response, the government acted aggressively. In 2025, there were tax cuts that were announced to revive the consumption. GST rates were rationalized right ahead of the festive season. And the Reserve Bank of India also cut rates by a cumulative 125 basis points. With inflation staying extremely benign, the conditions are now for a gradual recovery in place. Remember, that's why the markets are not really expecting another consumption stimulus in the upcoming budget. Instead, they want the budget with no negative surprises, one that sticks to the fiscal consolidation roadmap and also supports the ongoing recovery in the economy. But the fiscal picture is still tight. Revenue growth has actually fallen short of estimates, while expenditure has risen due to the front-loaded capital spending that the government has done. As a result, the fiscal deficit has already reached 62% of the full-year target in the first 8 months of FY26, compared to 54% last year. Even so, the government is expected to meet its 4.4% fiscal deficit target for FY26. However, achieving the next milestone, that's 4% in FY27, will require spending discipline, especially under the new debt to GDP framework. Assuming 10% nominal GDP growth in FY27, the fiscal consolidation would cap the deficit at around 15.7 lakh crores, broadly similar to what FY26 levels are. So what can the budget truly deliver this time? Stock markets are expecting high single-digit growth in capital expenditure, with defense and railways likely to be getting the priority. The government may also expand the PLI scheme to new age sectors like AI, space, robotics, offer support to exporters that have been hit hard by tariffs and push harder for green energy. Will there be a surprise this time? Well, big bang reforms or large giveaways are largely unlikely. However, one issue that continues to bother the investors is the capital gains tax on the stock markets. Any tweak in short-term or long-term capital gains tax on equities can significantly lift the sentiment, but expectations here still remain low. Now, while the downside still looks limited as far as the markets are concerned, because valuations are supportive at around 20 times one-year forward earnings, Indian markets are still trading below their long-term average valuations seen around the budget time in over the last decade, and this suggests limited downside. Until and unless global risks escalate from here sharply, that also, fingers crossed, are unlikely at this point. So what's the bottom line? This 88th Union Budget to be presented on 1st February 2026 is unlikely to disappoint markets, but it may not be a game changer either. A fiscally disciplined budget with targeted growth support should definitely keep the market steady, while any move, like I said, on capital gains tax could really be the big trigger for excitement. Indian stock market investors are already facing a lot of taxes and charges, including the LTCG, the short-term capital gains tax, the securities transaction tax, there's stamp duty and an 18% GST on services like brokerages and transaction fee as well. So any relief here may propel the stock markets higher. But again, the expectation here is not too high.
If you like the video, do like, comment, share and subscribe.